Hi, I am CA Pritish, and in this video we are going to talk about the taxation or tax implications in case of sale of inherited property, whether it is short-term capital gains or long-term capital gains, cost of acquisition, holding period, calculation of fair market value, improvement cost, and how you can save tax in case of sale of inherited property. So first, what is inherited property? Inherited property is nothing but the property, whether immovable property or movable property, that you receive through will or by the way of inheritance. So in this case, when you receive the property in your name, it is not taxed at all. It is only taxed when you sell the property and not at the time of inheritance. So keep this in mind because this is a frequently asked question. So only when you sell the property, it is taxed. So you can receive movable or immovable property. Say movable, for example, gold, shares, mutual funds, even bonds, even cars. So these are the movable properties that you can receive. Whereas in case of immovable property, that is land or any residential house property that you receive. And what is the capital gains tax on that? So now let us focus on an example. In case if you receive the property, say from your father in the year 2022 after his demise, and the same property was bought by your father in the year 2010 for rupees 10 lakhs. So how the capital gains is calculated in this case? So you have received the property in the year 2022. So when you have inherited the property, there is absolutely no tax at all. But now you decide to sell, that is in the year 2023, that is when the capital gain tax has to be calculated. Now how capital gains tax is calculated is using a simple formula. So capital gains tax is equal to sale value minus cost of acquisition minus cost of improvements, and in case if you have incurred any selling expenses, that will be deducted. So the balance amount will be taxed as capital gain. So before getting into the capital gains calculation, we need to focus whether it is short-term capital gains or long-term capital gains. So in order to determine short-term or long-term, we need to know the holding period. In case if the property is held for a period more than 24 months, then it is long-term. If it is less than 24 months, then it is short-term. So why this bifurcation is important is for the simple reason that long-term capital gains are taxed at the rate of 20%, whereas short-term is taxed as per your slab rate. In case you fall under the 20% or 30% bracket, then even your short-term capital gains will be taxed accordingly. So in our example, in case of inherited property, your father inherited the property in the year 2010. So the actual holding period will not be from the time when you actually get the property or inherit the property, but the holding period is from the year 2010, the property in which your father had got it, that is in the year 2010. So in this case, the holding period is more than 24 months and it is long-term capital gains and will be taxed at the rate of 20% when you sell the property. So now coming to the capital gains tax calculation, say your father had bought the property in the year 2010 for rupees 10 lakhs and you sell the property now say for rupees 30 lakhs. So as per our formula, the sale value is rupees 30 lakhs. The cost of acquisition is rupees 10 lakhs, but we need to compute the indexed cost of acquisition. Why indexation is important? Because 10 lakhs has to be adjusted to the cost of inflation and we need to calculate the value of 10 lakh rupees as on date. And how it is calculated? Based on the simple chart that the income tax provides year on year basis. So the cost of inflation index in the year 2010 is rupees 167 and in the year 2023 for the current year it is 331. So based on our formula, it is 10 lakh into 331 divided by 167, it comes to 19 lakh 82,000 rupees is the cost of acquisition, which has to be deducted from the sale value of 30 lakh rupees. And in case if your father has incurred any cost of improvement in any year after 2010, say for our example purpose, we'll keep it 1 lakh rupees he has incurred in the year 2010 itself, and then the computation goes as. So the capital gains that you see on the screen will be taxed at the rate of 20%, not the entire sale value, but only the remaining capital gains, the profit amount will be taxed under long-term capital gains at the rate of 20%. So now a most important and frequently asked question that we have, if the property was inherited by my father, which is very old, then in that case how the cost of acquisition is calculated. So the base year for computing the cost of acquisition or indexed cost of acquisition is 1st April 2001. In case if the property is inherited before 1/4/2001, then in that case the fair market value as on 1/4/2001 will be considered as the cost of acquisition. So how to compute the cost of acquisition, or rather fair market value on 1/4/2001, will look into it. There are a couple of ways to determine the fair market value as on 1/4/2001. The best way to do it is to find out the government valuation or the stamp duty valuation as on 1/4/2001 in case of that property, and that will be considered as the fair market value, and then you apply the indexation formula and then arrive at the cost of inflation index, but the problem cost of acquisition. But the problem here that we face is that the government valuation is always less when it is compared to the market value as on that date. The next option that we have is to identify in case if there has been any sale of an identical property around that place, around that time, then we can consider that value to be the value or the fair market value of our property as well. But this is open for litigation and the income tax department may not agree to this. And the third option that we have is a pretty simple one, that is to get it valued from a government registered value and find out the fair market value as on 1/4/2001, and that will be considered as a fair mark or cost of acquisition, and then that has to be indexed to arrive at the cost of acquisition as on date. So in addition to this, you need to add cost of improvements as well. So always ensure that in case if you have any capital expenditure, ensure that you have bills, vouchers or any supporting documents so that you can substantiate the expenditure that you have made, because there are few case laws also where the income tax department has rejected the cost of improvement where there are no bills in spite of providing the photographs of capital expenditure. But this is again a point of litigation where we can consider. Now the last question is, who is going to pay tax when you have inherited or there are multiple inheritors of the same property? Here you need to pay tax only to the extent of the share that you have received and not on the entire amount. So you need to divide your share and then pay tax accordingly. Even the cost of acquisition also will be divided to the extent of your share only and not the entire amount. So in case if there is any capital gains, then you need to discharge your capital gain tax. But in case if you want to avoid paying any capital gain tax, then there are legal ways of saving paying capital gains. So for which I have made a separate video, and the link I have provided in the description below. In case if you have any doubts, queries, please feel free to post your comments below and I will answer them. Thank you very much for watching this video, and please subscribe in case if you haven't subscribed, and also I will be posting more interesting content on taxation, finance and many more interesting subjects. Thank you very much.